I'm going to start tax planning session number 3 with some better news, okay? Thought I'd go for a positive for a couple of slides. I don't think most of you, including myself, are filling in their self-assessment tax return correctly when they're higher rate taxpayers. If you are generous enough to make donations and they fall under gift aid payments, the vast majority of us are not completing the section on our self-assessment tax return that we should be. That saves us tax. If I simply donate £100 to charity, they claim gift aid relief, so their donation they get is £125 really. If I'm a higher rate taxpayer and I'm paying myself a dividend of £40,000, by filling in the right section of my tax return, the band before I become a higher rate taxpayer gets extended by the £100. So by simply filling in a box correctly on a self-assessment tax return, you can see a tax bill of £7,875 reduces to £7,842.50. Don't look all overexcited, that's about as good as the news gets tonight, okay? Right. For any of you that went to university, had a student loan and you're still repaying it, I think the Chancellor may have missed something, because actually the amount he's going to recover in student loan repayments is going to be lower. Because when we look at your total earnings going forward, actually because there's no notional 10% tax credit on your dividends, your total income is going to be lower. And student loan repayments are calculated on total earnings, and therefore, I think in my little example, with an £8,000 salary and an £11,000 dividend, by the time we haven't grossed up that dividend, the student loan repayment in even a really low earner like that is going to be £135.45 less. So, there you go. Second piece of good news. I can perhaps try for a third. Keeping that thought in mind about the notional rate of tax, then some of us pay the higher rate child benefit charge. This is basically where one partner or another in a relationship with a child earns greater than £50,000 a year in income. But yet again, my earnings are going to be showing lower, aren't they? And therefore, if he doesn't move that £50,000 cap, which he hasn't, the amount of higher rate child benefit charge that I'm going to have to pay him each year by receiving my child benefits will drop. Okay, interesting. So on a £38,000 net dividend, I wouldn't have been able to claim higher rate child benefit for my children because I've passed the £52,000 cap. Sorry, I would have been able to claim, I'd have had to have given £301 of that back. Because that £38,000 net income isn't grossed up to the dreadful £42,222 that it is in the current year, my total income is 49k. I can claim all of my higher rate child benefit. If you're in a position that you've been over 50k, you've stopped claiming, and now because you haven't got the notional rate you can reclaim, please notify HMRC and get your money back. You deserve it. I haven't included it in the pack because it doesn't always apply. But quite often when we apply for a mortgage, HMRC ask for a form called, the mortgage provider asks you to get from HMRC a form called an SA302. And on the SA302, it confirms the income that you've put onto your personal tax return. For those of you that need higher income to be able to secure the mortgage that you need, actually not having that notional rate of 10% tax charge is going to bring your income down by 10%. So actually, your income is going to be lower for mortgage purposes. Okay, told you it would go bad again. Okay, should I take a salary? Should I give up on my dividends, just take a salary each month? Is it actually better to pay myself a bonus and draw down against that? So I've been used to living on £39,100 into my bank account. I've taken my £10,600 salary. I've maxed out my dividend of £28,500. I wasn't going to pay the taxman a penny in dividend tax if I could help it. Most of us are still going to need that money or want to have that money coming into our personal bank accounts. So going forward from the 5th of April 2017, is there something better to do than what I've been doing, this mix of salary and dividend? Well, all of the workings are in your pack, but depending on whether you're taking a salary of 8k or 11k, what we see is that the best and the most optimum solution is to continue doing what we've been doing. This new dividend tax came along, and the first phone call I got was the obvious phone call, which was, actually, should I bother running a limited company any longer? I think his question was more like, should I bother running a company or a business at all any longer? But actually he meant, is it time to not actually deal with the red tape and the company law and have the limited company status? Is it actually time to operate as a sole trader or a partnership? Now, I think I've proven to you this evening that there's ways to make dividend tax less painful. But there are a number of us that sit here that we're still going to be the sole shareholder of the company. We might only be able to claim a salary of £8,000 rather than £11,000. We don't have a spouse. We haven't got anybody to give any shares to. That doesn't create a huge capital gains tax liability. And for those people that don't want a company car because it doesn't work for them, because its CO2 emissions are too high, and they don't go to the gym, and they don't want medical cover, actually, we're pretty stuck, aren't we? For those people, depending on their profits, if there is no alternative, actually it may be time to unincorporate. That decision I would make is purely, obviously, on a tax basis. There's obviously a lot of benefits to being a limited company aside from tax. It's a separate legal entity. I can't lose my house. There's a status thing about running a limited company, or I may just be involved in a company that's been set up since 1923, and of course I'm a limited company. What I've included in your pack, if you're asking yourself that question, is looking at various different profit levels that your company may be achieving, and working on the basis of you being that sole shareholder with no opportunities and no options available to you. Actually, if I take a business with a £20,000 pre-taking my salary profit, and I look at the numbers, the tax saving of being a limited company isn't the £2,000 that I guaranteed you all when we incorporated you it would be. Actually, that differential is down to just £501. Now, a limited company has to pay bank charges because we have to have a separate bank account, or we keep swapping for the new deal. We know our fees are higher if you operate as a limited company than if you do as a sole trader. And we know that HMRC allow maybe a little bit more flexibility in the expenses that are claimed by the sole trader. So, as an example, motor vehicles are sometimes a lot easier to disguise as a sole trader than a limited company. I think what this is saying to me is if there isn't the options to withdraw and extract dividends through some of the slides we've talked about earlier, I'm a sole director, sole shareholder company. I probably wouldn't be recommending limited company status to anybody in a risk-free business where profits are less than £30,000 any longer. Okay? Depends on other sources of income that you have, but if it is your sole source of income, we probably need to have a conversation. Sad times for the sector. I will caveat that when you think about that and look at those calculations before you come and talk to us and say that Class 4 national insurance contributions are currently 9%. There was a lot of rumour amongst our sector that we thought that Class 4 national insurance contributions would go to 12% in the budget, and they didn't. If he's holding that one back, we may find we're unincorporating you to re-register you as a limited company, which we don't want to go there. Just a few other thoughts. Many of us extract money in lump sums from our limited company as a dividend to make an investment, maybe to buy our own personal house, to pay off a mortgage, to buy a really nice car. But I know a number of you actually take money out of your company in lump sums to buy property, residential property, so buy to let. Of course, we've seen the example of taking that extra £25,000, which we probably need to take as a deposit in this day and age. And we know the impact of dividend tax on that. We saw that, that's in your workbook. We have the case study. What is actually coming to the market more and more is the opportunity to have mortgages in the name of the limited company on residential properties. So actually it may be time for you to start holding those properties in the limited company in its name. By doing that, we don't have to take the money out for the deposit, and therefore we don't have to pay dividend tax. It does mean that the property is owned by the company, or maybe we would look at setting up a wholly owned subsidiary of the company to put that rental property into. Again, back here, 8th of March, 1745, prompt, and the seminar will be covering commercial property as well as that point. So, getting a bit personal, where am I going in all of this? I've always been quite open and honest with any of you that come to our seminars about my financial situation and how my company operates and is run. Now, I really don't like dividend tax. I'm not a rule breaker particularly, and I'm quite an opinionated little bugger sometimes, but this one really hurt, really hurt me. And it makes you start asking a lot of questions. And my question, which is why we're here this evening, is how the hell do I avoid it? Now, I'm used to taking an amount of money out of my company, and quite a lot of that, as you know, has gone into rental properties, or maybe sits in private investments. Actually, what I think the government is going to see, and maybe we could all stick to the same policy for a little while at least, is I'm not going to pay 32.5% tax on a dividend. I'm simply not going to declare a dividend. I'm going to keep my money in my company. Now, the grand plan of Linda, as we all know, is one day Coalesco won't be headed up by Linda, but by a successor. And I hopefully will sell my company. Now, if my company has an amount of money in it when I sell it, I take that money as a capital distribution, not as a dividend. And as such, something called entrepreneur's relief comes into play. So I don't need to take the money from my company. I'm certainly not going to buy investment properties at the moment, given where tax is going. So actually, that money is going to build up in my company, certainly for a period of time, hopefully for long enough for the Chancellor to change his rules back again because he notices his revenue comes down, because we're all going to do the same. What entrepreneur's relief means that on a capital distribution, I'll pay personal tax of just 10%. That's a little bit different to 32.5% each year, isn't it, on money that maybe I don't need or I choose to invest differently. So there's a case study in your pack that says for 10 years, I didn't take £20,000 a year out of my company. So I had 200k sitting in my bank account. If I'd have taken that money on today's rules as a dividend, I'd have a tax liability of 65k. If I either sold my company or used this word members voluntary liquidation, which morally I might not agree with, I could actually make a claim under entrepreneur's relief, and I could take that £200,000 out and pay 10% capital gains tax maximum. And that's £20,000 as opposed to £65,000. My strategy is a little bit risky right now because I think entrepreneur's relief may go away before I retire. But right here, right now, I'm not paying dividend tax of 32.5%. The alternative is that I may look to exit my company, not sell it, not go down the MVL route, but I may just simply keep my company going for a period of time and take that money out of my company as dividends, maybe as salary, over perhaps a 5-year period. So maybe when I'm 50 and travel in Australia and I don't have any other sources of income in the UK, Coalesco Accountants Limited might still exist and be paying me a dividend. And I will be paying tax at 7.5% on that, as opposed to the 32.5% today. I do that until I'm 55, then I start pulling the money out of my pension, where I've been putting all of my other money that I was willing to invest. So there's opportunities when we're looking at exit, either through retirement or through sale. That means that actually some of this tax is avoidable if we don't need to take the money. If we need to take it, we're going to have to pay tax. There's two ways about it. As I say, opinionated, yes. Stubborn, yes. Believe we all pay a fair amount of tax? Yeah. Believe we should pay dividend tax? Actually, no, I don't. This is why you're here tonight. There is a petition. There's a link in your pack. It's not our petition. It's a petition that's got 58,000 signatures. It needs £100,000 to be talked about in government. 100,000 to be talked about in government. This petition is basically needing your name on it to say that you don't want dividend tax to come about. The reason that I think dividends should be free of tax, certainly up to a higher tax rate, is us guys in this room take quite a lot of risk to get the reward that we take. It's very different to be an employee, isn't it? And that free amount of money we used to get of tax was actually to pay us a little bit more for what we got. And that's being taken away from us. So maybe tomorrow you'd like to put your name on that petition as well. Lots of food for thought tonight, lots of detailed numbers, lots of things that might not be relevant to your business or circumstances, but hopefully some things that you can tap into and use. But please go away, have a think about what we've talked about and see what you can do to make your personal situation better. Thank you very much. Thank you.